Hello and welcome to part 2 edition of Marginal Costing, Profit Planning and Decision Making Problems. As I have said earlier, there are a number of selected problems on marginal costing, profit planning and decision making will be provided to you. That is where the techniques of marginal costing, namely CVP analysis, that is cost, volume, profit analysis, and BEP analysis, that is break-even point analysis, can be applied to solve the problems. Now, as you know, marginal costing is a very important topic from the examination's point of view, and the problems are selected in such a way so that all the syllabus of different professional institutes like CPA, CFA, ICA, ICMA, etc. can be covered. So I request you to carefully watch the video, look how I am solving these problems so that you can get a good command over the topic, and no question in the question paper on this topic can put you down. So, ladies and gentlemen, look at the whiteboard where I am going to solve a problem. First, for a quick recap, let me write the set of formulae used in marginal costing. The formulae are sales minus variable cost. This gives contribution. From contribution we deduct fixed cost, that gives us profit. This is the basic formula or basic structure of marginal costing technique, and in addition to it we have the following formula. Number 1, sales in money value, that is in dollar value, is equal to fixed cost plus profit divided by PV ratio. Sales in units equals to fixed cost plus profit and a whole divided by contribution per unit. Right? Number 2, BEP sales in money value, that is in dollar value, equals to fixed cost, that is no profit, no loss. So nothing will be added or nothing will be deducted, nothing will be added with or nothing will be deducted from fixed cost. So fixed cost divided by PV ratio. Correct? And BEP sales in units is equal to fixed cost divided by contribution per unit. Correct? Number 3, margin of safety. MS means margin of safety, equals to total sales minus BEP sales or we can also apply this formula, or profit divided by PV ratio. Correct? So margin of safety is equal to total sales minus break-even sales, or you can directly apply total profit divided by PV ratio. So these formulae will be used to solve any and every problem on marginal costing. And you know, marginal costing is a technique that is used by the management in many decision making situations. Correct? So these are the formulae that will be used while solving this particular problem. Okay, so let me erase this part so that I can proceed further. Now the situation is given. A farm is producing 3 products, product A, product B and product C. Sales of the 3 products A, B and C are respectively 150,000, 90,000 and 60,000. So the total sales is 300,000. Variable cost of the 3 products are 120,000, 63,000 and 36,000, and total is 219,000. Contribution per product is 30,000, 27,000 and 24,000, and total is 81,000. The total fixed cost is 40,500, and profit before tax, that is the net profit, is 40,500. These data are given. Now the management thinks that some product lines are not that profitable, and if that product lines can be reduced in terms of number of units sold and distributed to more profitable ones, then profitability of the farm will increase. That means the sales mix of the products will be changed without any change in total sales, and of course there won't be any change in fixed cost. Now if the product which is giving lower level of contribution margin is reduced in terms of sales volume, and that sales is given to another product which is giving higher contribution margin to the farm, then definitely the profitability of the total profitability of the farm will increase, because the products which have more profit earning capacity are being sold more now. So the management contemplates of making a decision. What is the decision? Decrease product sales of less profitable product and increase sales of more profitable products. Okay. Now let us see the existing profitability of the farm and the PV ratios of individual products. Okay. So in this part we are doing the solution. We can start from contribution because variable cost is already deducted in the question, and also profit before tax is given. So we can start from contribution. Contribution of the 3 products are 30,000, 27,000 and 24,000. So 30,000, 27,000 and 24,000, and total contribution is 81,000. Less fixed cost How much? 40,500. So profit before tax is 40,500. Now let us find out the contribution margin of each product line. PV ratio that is equal to C by S into 100, that is contribution by sales into 100. So here it is 30,000 by 150,000 into 100. Here it is 27,000 divided by 90,000 into 100, and here 24,000 divided by 60,000 into 100. So this comes to how much? 30 out of 150, that is 20%. 27 out of 90, that is 30%. And 24 upon 60, that is 40%. Still, let me check with the calculator whether I am right or wrong. Yeah, 20%, 30% and 40%, correct. And what is the overall PV ratio? That is total contribution 40,500 divided by total sales 300,000 into 100, and this comes to 81,000. Total contribution is 81,000. Okay. So this is 27%. So the contribution margin is 20%, 30% and 40% of product A, B and C respectively, and the total PV ratio is 27%. Now you can see that product E is giving least contribution margin to the firm. Maximum contribution margin is given by product C followed by product B, and product A is giving the least contribution margin. Now, as the firm is contemplating, the management is contemplating, now it decides to reduce the sales of product A by 60,000 and distribute that 60,000 sales in between product B and C in the same ratio. Okay, you see, here only sales mix is being changed. There is no change in total sales, and there is no change in total fixed cost. That means the management is going to reallocate the resources. That means some resources will be withdrawn to some extent, not fully withdrawn to some extent from the products, from the product line that is giving least contribution margin, that is product A, and reallocate those resources in the production of product B and C. Correct? So the management now contemplates of reduce sales of A by 60,000 and distribute the same between B and C equally. That means in equal ratio, 50-50. So sales of A will fall from 150 to 90 because 60,000 is the amount of reduction. At the same time, sales of product B and C will increase by 60,000. That is, sales of product B will be 90,000 plus 30,000 and sales of product C will be 60,000 plus 30,000. So let us see the profitability in the new scenario, that is after the sales mix has been changed. So this is the evaluation of the proposal. Okay. Product A, product B, product C and total. Please notice that the firm is not altogether withdrawing the product line A. Why? Because product line A has a certain demand in the market, and due to competition, sales of product A is falling. In that scenario, the management wants to reduce the sales of product A and increase the production and sales of product B and C, so that the management can stay in the market in terms of selling product line A. At the same time, it can increase its profitability. Now let us see what happens if that decision is implemented. What is the PV ratio of A, B and C? 20%, 30% and 40%. Correct? So sales of the three products become 1,50,000 minus 60 of A, that is 90,000 of A, 90,000 plus 30,000, that is 1,20,000 of B, and 60,000 plus 30,000, that is 90,000 of C. So total sales remain at 300,000. Right? Now we deduct variable cost from sales. What is the variable cost of product A? That is 80% of sales, because 20% is the contribution margin. Hence 80% is the variable cost related to sales. So here it will be 80% of 90,000. Here it will be 70% for product B, because 30% is the contribution margin. So variable cost is 70% of sales, 100% minus 30% is 70% and 100% is the sales. So here it is 70% of 120,000 and here contribution is 40%, hence variable cost is 60%. So here it is 60% of 90,000. Okay. So this is 80% of 90,000, that is 72,000. This is 70% of 120,000. 7 2 are 84, that is 84,000. And here it is 60% of 90,000, that is 54,000. Correct? So what is the total variable cost? 72 2,10,000. Total is 2,10,000. So here we find out the contribution, that is sales minus variable cost. So contribution, here it is 90,000 minus 72,000, that is 18,000. Here it is 120,000 minus 84,000, that is 36,000. And here it is 90,000 minus 54,000, that is 36,000. Sorry, and the total is 90,000. Correct? What is the fixed cost? Fixed cost remains at 40,500. So we find out the profit, that is contribution minus fixed cost. 90,000 minus 40,500. It comes to 49,500. Okay, so this is the new profit, that is the estimated profit as a result of change in sales mix. Before the change in sales mix, the total profit was 40,500, and if the decision of the management, that is to reduce the product sales of product A by 60,000 and distribute that sales in between product B and C in equal proportion, then profit is increasing by the difference between 49,500 and 40,500. Correct? So profit, existing profit, $40,500, estimated profit, that is after change in sales mix 49,500. So increase in profit that is 49,500 minus 40,500, that is 9,500. So by applying the marginal costing technique, the management has got this information that if the sales mix is changed in terms of reduction of sales of product B and increase of sales of product B and C, then without any change in fixed cost, that is, the management will only reallocate the resources. That is, the management will withdraw some resources from product A and will deploy that resources in production of product B and C. And if the management does so, then total profit of the firm will increase by 9,500. So implementation of this decision would increase the total profit of the firm, hence the decision can be implemented. Correct? Yeah. So in this part, that is part 2 of marginal costing, profit planning and decision making, we have a problem, that is the firm is having some problem with the sales mix in terms of total profit. So the firm wants to change the sales mix to increase the profitability. We have applied the techniques of marginal costing and the formulae of marginal costing to find out the existing profitability of the firm and the individual PV ratios, and accordingly we have ranked. You can also rank the products, that is, first is C, B is second and A is third. So accordingly, as per contribution margin, the products are ranked. Product C stands first, followed by product B and product C. In this scenario, the management wants to decrease the sales of product A by 60,000 and distribute that sales in between product B and C in equal ratio. That is, sales of A will be decreased by 30,000 to 90,000, from 150,000 to 90,000, and sales of product B and C will increase by 30,000 each. So sales of product B will change from 90,000 to 120,000 and sales of product C will change from 60,000 to 90,000, and total sales will remain at 300,000. We have deducted the estimated variable cost from estimated sales. These are the PV ratios, 20%, 30% and 40%. And we know that variable cost is complementary to PV ratio. So variable cost of product A is 80%, of product B is 70% and of product C is 60%. So we have found out the variable cost, 80%, 70%, 60% of the respective sales. We have deducted the variable cost from sales and we have found out the contribution per product line as well as total contribution, and we have deducted the total fixed cost that has remained unchanged, 40,500. So total profit is 49,500. So the profit after implementing the decision is expected to increase by 9,500. Hence, the management can implement the decision to increase overall profitability of the firm. Okay? Yeah. so far so good. I hope you have enjoyed this video. I mean to say, the video has benefited you. If you think so, please share the video to your friends so that they can also get benefits of this video. And also I request you to like my channel, subscribe my channel, and please feel comfortable to send me comments, your queries, your doubts. If you need further explanation on it, on any topic, then you are most welcome. Okay, and thank you for watching the video. Goodbye and stay well.